Hello students, welcome to EPG Pathshala. I am Navina from Department of Commerce. Today we are going to talk about the module test of liquidity from paper Accounting and Finance. Learning objectives. It able to learn various liquidity and efficiency ratios. It helps to comment upon the short-term paying capacity of a concern. This module will help you to understand the efficiency with which the liquidity resources have been employed by a firm. Classifications of ratio. Analysis of short-term financial position. Classification of ratio. There are two types of ratio. Liquidity ratio. Under liquidity ratios, we calculate current ratio, liquid ratio or quick ratio, absolute liquid ratio, interval measure of defense interval ratio. Efficiency ratios: inventory stock turnover ratio, debtors turnover ratio, creditors turnover ratio, working capital turnover ratio. Liquidity ratios measure the short-term solvency or financial position of a firm. Liquidity ratios are calculated to comment upon the short-term paying capacity of a concern or the firm's ability to meet its current obligations. Components of liquidity ratio. Liquidity ratios include following four types of ratios. First, current ratio. Second, liquidity ratio or quick ratio. Absolute liquidity ratio. Interval measures or defensive interval ratio. Current ratio. Current ratio is calculated by using the following formula, that is, we divide current assets by current liabilities. Current assets include cash in hand, cash at bank, short-term marketable securities, bills receivable, inventories, prepaid expenses. And current liabilities include outstanding expenses, bills payable, sundry creditors, short-term advances, income tax payable, dividends payable, bank overdraft. Interpretation of current ratio. A relatively high current ratio is an indication that the firm is liquid and has the ability to pay its current obligations in time and when they become due. A relatively low current ratio represents that the liquidity position of the firm is not good and the firm shall not be able to pay its current obligations in time. Let's understand how to calculate current ratio with the help of example. Suppose we are given stock rupees 60,000, debtors 70,000, cash 20,000, BR, that is bills receivable 30,000, prepaid expenses 10,000, creditors 20,000, bills payable 15,000, tax payable 18,000, outstanding expenses 7,000, bank overdraft 25,000. Factors to be considered while calculating ratios. First one, type of business. A trading concern will require a high current ratio. Second one, types of products. A business dealing in goods whose demand changes fast will require a high current ratio. Third one, reputation of the concern. A new concern need higher current ratio. Fourth one, seasonal influence. In a peak season, current assets will be more and current ratio will be high. Weighted current ratio. Weighted current ratio is calculated like current ratio, as weighted current ratio can be calculated by using the following formula, that is total product of current assets divided by total product of current liabilities. The weighted current ratio is considered to be the more reliable than the ordinary current ratio as a measure of liquidity. Current assets includes cash in hand, cash at bank, short-term marketable securities, bills receivable, inventories, prepaid expenses, and current liabilities include outstanding expenses, bills payable, sundry creditors, short-term advances, income tax payable, dividends payable, bank overdraft. Liquid ratio or quick ratio. The term liquidity refers to the ability of a firm to pay its short-term obligations as and when they become due. It is also known as acid test or liquidity ratio. It is a more rigorous test of liquidity than the current ratio. A high quick ratio is an indication that the firm is liquid and has the ability to pay off the debts on time. High quick ratio is an indication that the firm is liquid. Low quick ratio represents that the firm's liquidity position is not so good. Second ratio, quick ratio. Quick ratio is calculated by dividing quick assets by current liabilities. Quick assets include current assets minus stock minus prepaid expenses. Quick assets can also be calculated as following: current assets minus inventories minus prepaid expenses. Inventories here will mean all types of stocks, that is finished, work in progress, and raw materials. Now, absolute liquid ratio. Absolute liquid assets include cash in hand and cash at bank and marketable securities or temporary investments. The acceptable norms for this ratio is 50% or 0.5:1 or 1:2. It is considered as adequate because all the creditors are not expected to demand cash at the same time. Now we'll see how absolute liquidity ratio is calculated. For calculating absolute liquidity ratio, we use this formula. Absolute liquidity ratio is equals to absolute liquid assets divided by current liabilities. Absolute liquid assets include cash in hand, bank, plus short-term securities. Next ratio is interval measure or defensive interval ratio. It measures whether the liquid assets are sufficient relative to the firm's daily cash requirements for operating expenses or not. For calculating this ratio, we use the following formula. Interval measure is equals to quick or liquid assets divided by average daily cash operating expenses. Quick assets includes cash, short-term securities, plus any types of receivables. Average daily operating expenses can be calculated as following. It includes COGS. COGS means cost of goods sold plus administrative office expenses plus selling and distribution expenses less depreciation or any other types of non-cash expenses divided by number of days in the year. That is, you can take it as 365 days or 360 days. Okay, let's understand how to calculate interval measure ratio with the help of example. For example, you are given with the cost of goods sold 67,000, administrative expenses 35,000, distribution expenses 13,000, liquid assets 15,000. Now let's calculate that interval measure ratio. As we know, interval measure is calculated by using this formula, that is liquid asset divided by average daily cash operating expenses. First of all, we'll calculate average daily cash operating expenses as sum up 67,000 plus 35,000 plus 13,000, that is equals to 1,15,000. Now we'll divide these average daily expenses by 360 days, and that will be equals to 319. Now with the help of these two, we'll calculate interval measure by dividing interval measure by average daily expenses, that is 1,15,000 divided by 319, that is equals to 47 days. Efficiency ratios. Funds are invested in various assets in business to make sales and earn profits. The efficiency with which assets are managed directly affects the volume of sales. Optimum utilization of available resources is very important in every organization. The better the management of assets, the larger is the amount of sales and the profits. Activity ratio measures the efficiency or effectiveness with which a firm manages its resources or assets. These ratios are also called turnover ratios. Now we'll study about types of efficiency ratios. There are four types of efficiency ratios. First, inventory or stock turnover ratio. Second, debtors turnover ratio. Third, creditors turnover ratio. Fourth one, working capital turnover ratio. Now we'll study about inventory turnover ratio. Inventory turnover ratio is also known as stock velocity ratio. It is normally calculated as sales or average inventory or cost of goods sold or average inventory. High inventory turnover ratio indicates efficient management. Low inventory turnover ratio indicates inefficient management. Next ratio is inventory turnover ratio. Inventory turnover ratio is calculated by dividing cost of goods sold by average inventory at cost. COGS, that is cost of goods sold. It may not be known from the published data. In such case, net sales is considered as cost of goods sold. Now, debtors turnover ratio. To measure the liquidity of specific current assets, in order to understand the quality of current assets, it is very important to calculate the debtors turnover ratio. A company's ability to collect from its customers in a prompt manner enhances its liquidity. The debtors turnover ratio measures the efficiency of a firm's credit policy and collections mechanism and shows the number of items each year the debtors turn into cash. It indicates the velocity of debt collection of firm. In other words, it indicates the number of items average debtors are turned over a year. Thus, debtors turnover ratio can be calculated by using following formula. As debtors turnover ratio is calculated by dividing net credit annual sales by average trade debtors. Credit is one of the important element of sales promotion. In average trade debtors, we calculate average trade debtors by adding opening trade debtors with closing debtors divided by 2. Next ratio is creditors turnover ratio. In the course of business, a firm has to make credit purchases and incur short-term liability. Indicates the velocity with which the creditors are turned over in relation to purchases. Higher the creditor's velocity, better it is. Lower the creditor's velocity, less favorable are the results. Creditor's turnover ratio can be calculated by using the formula as by dividing net credit annual purchases by average trade creditors. If credit purchases are not given, then total sales may be considered, whereas average trade creditors can be calculated by adding opening stock of creditors to closing stock of creditors divided by 2. Working capital turnover ratio. Working capital turnover ratio is directly concerned with sales. The working capital is taken as working capital is equals to current assets minus current liabilities. This ratio indicates the velocity of the utilization of net working capital. This ratio indicates the number of times the working capital is turned over in the course of a year. Working capital turnover ratio measures the efficiency with which the working capital is being used by the firm. Higher ratio indicates efficient utilization of working capital. Lower ratio indicates inefficiency. Working capital turnover ratio can at best be used by making of comparative and trend analysis for different firms in the same industry and for various periods. This ratio can be calculated as using following formula. Working capital ratio is equals to cost of sales divided by average working capital. Average working capital can be calculated by adding opening working capital and closing working capital and then dividing these both by 2. Working capital turnover ratio can be calculated by using the following formula. We calculate working capital turnover ratio by dividing cost of sales by average working capital. Working capital will be equals to current assets minus current liabilities. So, students, let's now summarize what we have learned in this module. The current ratio, that is, current assets divided by current liabilities, measures the ability of an organization to pay off its debts. Though the ideal current ratio depends to some extent on the type of business. A general rule of thumb is that it should be at least 2:1. The quick ratio is more rigorous test of liquidity than the current ratio and is used as a complementary ratio to the current ratio. But both current and quick ratios give misleading results if current assets include high amount of debtors due to slow credit collections. In the same manner, current ratio may be further misleading if the assets include high amount of slow moving inventories, as both these ratios ignore the movement of current assets. It is important to have knowledge of efficiency ratios to comment upon the liquidity. Effective utilization of resources is in the hands of the management. The more effectively a company may utilize its resources, the better will be the profitability position of a concern. Thank you.